You had said before the policy meeting that you were somewhat uneasy about front-loading rate cuts based solely on slowing payroll growth, and that at the same time, inflation had been moving in the wrong direction, and just counting on inflation to be transitory made you uneasy. So why did you vote in favor of cutting rates last week? Was there anything that changed that caused you to want to take out more insurance?
Well, before the last meeting, not this November meeting, but in September, we issue the statement of economic projections, our dot plot projections of where the economy is going to be and where rates are going to be. And at that time, I thought there would be 2 rate cuts for the year. I'm balancing off 2 things. One, as you know, I believe that the place rates will ultimately settle is a fair bit below where we are today. And as long as we can get the dust out of the air, I still think that golden path is possible. And I'm trying to weigh that off with these concerns about front loading, especially when we have the data shut down. We're getting some information about the job market, and we have very little private sector information about inflation. So I think we want to be wary, but I'm still just trying to balance those off. Not much change since the September SEPs, and so I had no problem with that.
So, Austan, you're saying you're trying to sort of look through all this dust, waiting for it to settle. You had penciled in 2 rate cuts for this year, and Chair Powell had said after the policy meeting last week during his press conference that there's a feeling that you've cut twice and you're now 150 basis points closer to neutral than you were a year ago, and that there is a growing chorus on the committee that perhaps maybe you should wait. Are you one of the chorus?
I'm not supposed to say anything about what other folks say. In my mind, as you know, I am uneasy with front-loading rate cuts. I do believe rates will come down, but in a way, rates should come down with inflation. We've got to, if we're just going to count on the inflation that we've seen here, where the last 3 months core inflation is running 3.6% at an annualized rate, and core services, I think, are running close to 4% as annualized rate for the last 3 months. That's worrying because that's going the wrong way. If we're just counting on that to go away because it's transitory, that makes me uneasy. So I'm not decided for what I think about the next meeting, and we are still going to get at least some private sector observations and the Chicago Fed's labor market indicators telling us some about the job market. We're probably not going to get much on the inflation side, so I am a little wary, and my threshold for cutting is a little bit higher than it was in the last 2 meetings.
So to your point, Fed Chair Powell used the analogy of when it's foggy, you want to slow down, become a little bit more cautious. Is that a fair characterization for you? And how are you viewing the balance of risks? Fully recognizing that we haven't had official data on the labor market side because of the government shutdown. It sounds like you may be more worried about inflation than employment now when you look at the balance of risks.
I've been a little more worried about inflation than the job market if you think of it as a balance of risk, for the reason that other than payroll job growth, if you look at things like the unemployment rate or other rates that are less affected by population changes or immigration policy, those things have been pretty stable for some time. If you look over the last 12 months, the unemployment rate has not been going up. We haven't seen a big uptick in layoffs, which if this were the beginning of recession or deterioration of the labor market that was rapid, you would expect to see higher layoffs or firing, and we haven't seen that. There's still concerns on that side. And as you say, we're going to get some private sector data, so we can at least keep observing that. But I just want to emphasize, be very careful at moments of transition where you're trying to figure out whether the economy is turning. relying too heavily on 12-month backward-looking numbers like the 12-month trailing inflation. Each month we get a number, and 11 of the months we already knew. The new information is only for that new month. So the fact that the last 3 months inflation is not going down but is instead going up, including in some categories that are not driven by tariffs like services, those are areas of concern. And so that's a little bit, the last time you looked out the window, there was a mountain lion sitting in your front yard. So before you let Fluffy out to go run around, let's at least get one more look.
All right, well, aside from Fluffy, I do want to come back to the job market because, yes, payroll growth did slow over the summer months, and since then you sort of have been in the dark as far as official data. But last week we saw some major layoff announcements from the likes of Amazon to UPS. If you did look at private sector data, ADP's measure turned negative for the month of September. We're going to get another measure this coming Wednesday. And the Beige Book revealed that employers are looking at cutting headcount either through attrition or layoffs due to policy uncertainty, weaker demand, and AI. Does that not worry you? Do you think that perhaps payroll growth has decelerated further since you have gotten official data?
It might have, and that's why, as I say, I'm not decided going into the next meeting. I want to see how things are playing out. I do think the public announcements of layoffs, you would expect, if that is an immediate business cycle driven matter, that you would start to see an uptick in the official unemployment insurance statistics or the layoff statistics, or you would get WARN Act type data of that form that would give you a little bit of a heads up of what was coming in the job market. I do think the hiring rate is low. That's among the weakest things in the economy at the moment, and that's made it particularly tough for new graduates and young people. But a low hiring, low firing economy is unusual. That's the kind of economy that you expect when there's a lot of uncertainty. Normally, in the business cycle, you would have low hiring, high firing, or low firing, high hiring. When you get uncertainty, both of those go up as people kind of pull back and say they want to wait to see how things are going before they make decisions. This whole second part of what's going on in the job market, if it is being driven by AI, if it is concentrated in the tech sector, that doesn't feel as much like the business cycle to me and economic stabilization. That feels like more of a structural shift in what sectors are going to be employing people. So we have to think through, what does that imply for monetary policy? That's a little different than if you were afraid that we were going into recession.
Yeah, so to your point, what is all of this telling you about the outlook for the economy in a cyclical sense, right? Not a structural sense, because that is what you have control over at the Federal Reserve. Perhaps are we at a turning point in the economy, given what we're seeing in private sector job market data that GDP data is not yet reflecting?
Yeah, look, I always say one of the hardest things the central bank ever has to do is get the timing right on moments of transition. And that's especially difficult if you have squished bugs covering the windshield and you can't see whether you're still on the road. And when they shut down the data, the official data, that's the circumstance we're in. So I don't know that it's decided. I'm not decided going into the December meeting. I am nervous about the inflation side of the ledger, where you've seen inflation above the target for 4.5 years, and it's trending the wrong way. I believe on the other side, rates can come down a fair amount. It would probably be most judicious to have the rates come down with inflation. So let's get some observations that document that inflation is coming down and that the uptick we've seen is transitory. But we've got to weigh that off. If the job market starts to deteriorate in a more significant way, then that would change the balance of risk.
Treasury Secretary Scott Bessent said yesterday that he believes that parts of our economy, particularly housing, may be in a recession already. Sounds like you may disagree with that. What are your thoughts on that?
Well, I think he's right that the housing construction sector's been weak. It has been weak now for some time. The three most interest rate sensitive parts of the economy usually that give you a sense of the business cycle are housing, consumer durables, and business investment. I think he's right to highlight housing's been weak. Consumer durables have been pretty resilient. And you saw, as you said, the GDP numbers coming in and consumer spending coming in pretty solid. And business investment has been kind of off the chain. Now, much of that driven by the AI boom, so that might not be cyclical, but the interest rate sensitive parts of the economy don't feel like they overwhelmingly point to that we're in a slowdown. I think that the economy has been pretty strong. The economy is pretty solid and has been. There's weakness in sectors, and anybody who's dependent on intermediate goods that the tariffs are applying to has been suffering. But other parts of the economy continue to grow, and overall consumer spending remains the main driver of solidity. Is that of the solidness of the economy has been largely based on consumer confidence.
Well, Austan, unfortunately, we're out of time. We'll have to leave the conversation there. Always so many more questions for you. So appreciate your time and insight this morning. Hope you'll come back and see us soon.
Yeah, anytime, Jennifer. Thank you for having me.